It's been almost 2 decades since inflation reached the levels recorded last month. People are feeling it at the gas pump, the grocery store, and in bigger ticket items too. What's causing it, and can it be brought under control? Let's find out by asking, in Halifax, Nova Scotia, Rebekah Young. She's Director of Fiscal and Provincial Economics for Scotiabank. And in Midtown of Ontario's capital city, Benjamin Tal, Deputy Chief Economist of CIBC World Markets. And it's great to have you two on TVO tonight for a conversation I suspect a lot of people want to have a much greater understanding of, namely why inflation is where it is today when it hasn't been this high, as we say, in nearly 2 decades. Let's start, if we can, Rebekah, by having you tell us, when the Bank of Canada says inflation is running at 4%, what goes into getting to that number?
Well, first of all, we've all heard of the CPI, so that's a basket of goods. So basically what it's saying is, how does a basket of goods, if you were to walk into a shopping center and buy the same basket of goods this month as you did last month, how much more did you pay this month versus last month or last year? So it's really trying to put a common measurement around what is the average Canadian household feeling in terms of prices going up over time. So it really is an average. Now, the Bank of Canada will have, many different variations of that metric to calibrate its policy, but at the very basic level, that concept is how much more is an average Canadian household paying than they did relative to last month or last year.
Benjamin, let me follow up with you in this regard. For policymakers and for politicians, for deciders, to be able to make the best decisions as it relates to dealing with inflation, whatever economists put into that basket is pretty key, right? Because if you're not measuring the right things, then that number really doesn't mean much. What's in that basket, and how do we know that it truly, truly accurately reflects the state of play for the average Canadian day to day?
Yes, that's a very good question, because during COVID, we know that the basket changed because we weren't consuming services. We consumed a lot of goods because you press a button and you get your exercise bike. So the distribution was very different. And Stats Canada basically changed the way they calculated it to reflect that. So that's why we saw a little bit of volatility in the numbers. But you're absolutely right that it's a reflection of what's happening at a point in time. Now, there are some prices that can go up and down very quickly, like food prices, like energy prices. And that's why the Bank of Canada likes to focus on something called core inflation and other measures that really exclude all kinds of volatile segments of inflation. So you really want to focus from a policy perspective on what's stable, what's really a real increase in inflation, as opposed to just a one-day jump in food prices. And that's a challenge that they're facing now.
In which case, Rebekah, obviously food would be in that basket, but gasoline would be in the basket, gasoline for your car. But what else? For example, I know 20,000 people who went to a football game in Toronto yesterday. Would the cost of a football game ticket be in the basket? Would the cost of buying art at an art gallery be in the basket? How do you know what's in and what's out?
Absolutely. So if you're really interested, you can go on StatsCan's site and see down to the second decimal point what percentage these activities will be in the basket. So obviously, recreation is a smaller share of the basket. So for the average Canadian household, about 50% of those expenditures are around shelter and food and energy costs. So, and clothing as well. So what you might consider the essentials. But that really is an average. And so one of the reasons why Canadians feel inflation differently is that we're not the average Canadian, is that we have different shopping habits, and we also have different levels of disposable income. And so not every Canadian is out there buying football tickets, so they may be feeling inflation different than that average metric that StatsCan is providing.
I noticed there was a lot of inflation.
If I may, actually.
Sorry, go ahead, Benjamin.
One thing about shelter, because people say, house prices went up by 20%. How come it's not in the CPI? Because that's not the way they measure it. They measure basically consumption of housing services as opposed to the house of price, the price of the house. And that's something that we have to take into account. So people are looking for the CPI to reflect the huge increase in house prices. You will not find it there. It's a much more sophisticated than that.
Okay, well, follow up with this, though, Benjamin, because if inflation typically runs at 2%, that's usually the target they like to go for, and then suddenly it ends up at 4%. You know, some people might look at that and say, well, that's only 2 points higher, so does that really affect my bottom line all that much? What's the answer to that?
Yeah, that's a very good question. So first of all, let me just say one thing. Nobody knows where inflation will be 6 or 8 months from now. And when I say nobody, I include the Fed in the US and the Bank of Canada. We are all pretending, but nobody really knows because we haven't seen in this kind of situation. So back to your question, the target is 2%. The Bank of Canada is very clear about the fact that they are willing to tolerate higher inflation, higher than 2% in 2021 and even 2022, as long as they can bring it back to 2% in 2023. Why is it so important? It's their credibility. It's not about the number. It's because what it shows. We have been fighting inflation for 50 years with a lot of success, namely banks, central banks established their credibility and their ability to fight inflation. And therefore, at the end of the day, it's not about inflation. It's about what will take to bring inflation back to 2%, because I think it will be back to 2%. But what it means in terms of what the Bank of Canada will have to do, what will be the cost to bring it back to 2%? They labored very, very hard over the past 50 years to establish that credibility. They are not going to give it up.
All right, before we figure out how and what levers they can pull to make sure inflation is at 2%, Rebekah, I need to have a better understanding from you as to what's magic about 2%. I know somebody a long time ago decided 2% is the target that Canada ought to be going for as it relates to inflation. But why 2 as opposed to 1.5 or 2.5 or whatever?
Well, I would first start off, we know right now that the Bank of Canada and Finance are asking that very question. Is that still the correct target? But the idea is, in very simple terms, is that 2% was considered, or is considered the magic number of, so-called greasing the wheels. So what is the right number that provides over time stable economic growth? So not these wild cycles of economic contractions and expansions. And two examples of how that would work, for example, is first of all, you wouldn't see deflationary debt cycles. So if we had a downturn and suddenly debt levels started ballooning in real terms and we had higher defaults. So kind of modest inflation over time prevents that. But it also prevents, it keeps employment whole. So we know that when when the economy turns sour, we don't see wages contracting. Wages are very sticky. You never see people getting, lower wages, but they get lower wages in real terms because of what's going on in the economy. So that provides a bit of an economic stabilizer in that, this modest level of inflation over time prevents or smooths the economic cycle over the medium term. And I would just add on to what Benjamin was saying about, why does the average Canadian care about that 2%? Like wages are a big one, is that, if inflation is at, 2, 3, 4%, Canadians at the end of the day want to know that their salaries are going to keep up with that. So yeah, it might be modest when on small ticket items, a small price increase, but the bigger picture is, are our salaries going to keep up with it so we can pay for that over time? So that's certainly one concern. And another concern then is, to Benjamin's point, is what will the Bank of Canada do? So what will it do to the cost of, whether we want to buy a new vehicle or whether we want to buy a house or whether we're a small business and we want to expand, like our costs will go up as well because of what the bank might do in response. So these are, two examples. And a third one I should mention is that it really does matter to certain households that are lower income households, and, small price differences can make a very, very serious impact on household ability to pay for things like food or shelter. And so those are just a couple of sort of real world examples why, that the headline number may not seem all that big, but it does have material impacts for the average Canadian household. Absolutely.
Benjamin, as an economist, when you look at two competing evils, I wonder if you could tell me which one concerns you more because it would have a greater nefarious impact on the economy and on everyday people's lives. High inflation or high unemployment? Which is the worst evil?
Yeah, that's a tough one because I think that if you have higher inflation and then interest rates go high in order to basically fight it, then you will get higher unemployment. So you can suggest that actually higher inflation will lead to a higher rate of unemployment. And therefore, to fight that, you have to maintain inflation, let's say, at around 2%. And this number is not just a magic number. It's a number that is reflecting demographics and many other factors that the Bank of Canada calculated over time. And it is interesting, the question that you're asking now, because people are toying with the idea that maybe the Bank of Canada has to do what the Fed is doing, basically maximize employment and minimize inflation to 2%. So basically, you have two factors here as opposed to only one, that is inflation in the case of the Bank of Canada. So that's a very interesting development. And I think that that's something that we have to consider. Clearly, I think that if interest rates rise too quickly, the unemployment rate will rise. And they are trying to basically reach an optimal level of interest rates and inflation, and therefore unemployment. That's basically what the Bank of Canada is trying to achieve. And when you have a situation like COVID, when inflation is rising faster than expected, you should be able to tolerate higher inflation for a while, as long as you know that eventually you go back to target, which is 2%.
Mm-hmm. Rebekah, help us understand this. You know, clearly decision makers don't want inflation up at 4, 5, 6%. They want it closer to 2. And yet, despite all of the levers they can pull, it's not at 2. What have we learned over the last many decades about just how influential government policy can be to keep inflation within the range that our decision makers want it at?
Well, I think that we've actually learned quite a lot, and Canada on the international level has a very strong reputation for its inflation targeting regime, one of the best, if not, at keeping average inflation at about 1.9%, so mid-range of its 1 to 3. So I think very strong credibility, and I would say they still have that strong credibility. Now, monetary policy is a bit like skate where the puck will be, not where it is. So it does take a good 18 to 24 months for, if they do something now, for it to feed through the system. So, Benjamin said earlier, we're really trying to figure out where inflation will be, a year and a half, 2 years hence. They're not, they don't have the tools, and they're not targeting what we're seeing today. So there is a bit of a surprise. And, I hate to use the word unprecedented because people are tired of hearing that word with respect to the pandemic and what had happened. But really, this is a very unusual downturn and a very, unusual government response in terms of how much fiscal firepower as well as monetary tools were thrown at it. So what we did see are very unusual dynamics where things like household disposable income was actually higher than it was coming out of the first lockdowns. Government transfers more than offset what wage losses were, and you wouldn't see that in a normal downturn, in any downturn that we've seen. So when we look at what's happening today with high inflationary pressures, it is a bit of a classic economics 101 of you've got, much stronger demand. So Canadians were in lockdown. They couldn't spend. They got, big government transfers. They want to go out now, spend in a reopening economy. But then you've got that supply challenge is, whether it was weather-related events that caused food prices to go up. We all know about semiconductor chip shortages and the vehicle lack of inventory there. It's truckers to move products. It's container ships. We've got a whole, supply chains really bungled right now. So you've got this combination of supply and demand factors, but they are, for the most part, temporary. We know the word transitory has been retired, but they should come back down to, something more of a normal world, normal inflationary environment when we look out to that horizon. Still a bit elevated in our forecasts, but that there is a bit of a question mark around that. So have there been structural changes as a result of the pandemic that we haven't yet accounted for in our economic frameworks? And so that's the big question mark, I think, figuring out, is the puck really going to, that 2.5% to 3% over that time frame? And so do they enact now, or do you wait a few more prints to see if something has changed durably? And so I think that's the big question is, where is that puck going, and when do we pull the levers?
I never thought that great economist Wayne Gretzky would be quoted so often on this program, but there you go. You've done it, Rebekah. Well, Benjamin, maybe you could follow up with this. You know, we had Perrin Beatty on this program a couple of weeks ago in which he said, if you're going to go out and do some Christmas shopping, go earlier than later because of many of the issues that Rebekah just mentioned, in particular supply chain. You're not going to find the selection that you want. I think the Liquor Board, the Liquor Control Board of Ontario announced same thing. If you want to go out and get all the different kinds of brands that you might like, do it sooner than later because we can't guarantee that the stock that you want will be on the shelves. How much, in your judgment, does all of that add to the inflationary pressure that we are, because of COVID, already feeling?
Yes, I think it does, quite frankly, because people are trying to get into the market before it's too late. And just to put things in perspective, people are talking about supply issues, but really it's, first of all, a demand issue, because just think of it. When it comes to services, we are almost back. We are not there, we are almost back. But when it comes to goods, we are now 25% more than where we should be in terms of demand. Just to put it in perspective, the increase in demand for goods in the US is equivalent to basically parachuting 75 million people into the US overnight, economically speaking, and when they land, they start shopping. That's what we're talking about. Even a normally functioning supply system will not be able to deal with this demand shock. And it's not a normally functioning supply system. It's very sick because of COVID. So we have two issues happening at the same time, and that's why prices are rising. But I think that people rushing, probably adding to this demand, and it's very possible, we cannot prove it, that some people, some retailers, and maybe producers are hiding behind the fog of supply chain issues and raising prices for no good reason. They have the inventories, but they still raise prices. We see it a little bit here and there. So I think that you're absolutely right, that this can actually lead to even higher inflation down the road. But it means that we are borrowing activity from the future. And that's why the issue facing the Bank of Canada is a bit complicated.
Well, Rebekah, would it be responsible then for, let's say, the Prime Minister of Canada to come out, to go to the lectern and say to Canadians, look, I know nobody likes inflation. Part of the reason we're having it is because you folks have this pent-up demand to spend because you haven't been able to for the last year and a half. Maybe don't spend so much right now, and that'll help bring inflation down. Can you do that?
No, I don't think that, I don't think that would quite work. And quite frankly, Canadians have been, fairly cautious in that spending. And I think, a question mark is how quickly will they unwind it? There is a degree of, markets doing their job in the sense that, consumer confidence is taking a bit of a toll. We don't have great data necessarily in Canada, but, last month in the US, the consumer confidence around buying a new vehicle plummeted to its lowest ever, even during the initial parts of the pandemic, even during the global financial crisis. So there is a bit of a calibration of kind of this sticker shock idea that eventually Canadians will say, I'm going to wait. I'm not going to buy it at this price. And so there is a sense that the slow pace of unwinding of these savings, it's not all on a precautionary basis because we're worried that the economy is going to get worse. If anything, we're not seeing the inventory at the prices that we want to buy. So I think market forces in this case will probably do a better job than sort of imploring Canadians to hold back. But I think you ask a good question because what are the levers to deal with this, and I think that that's where we do markets still have credibility in Bank of Canada's ability to control inflation over that medium time frame, and so I think continuing to execute policy that is grounded in data and grounded in well communicated policies around that data is still the best way to go.
Well, the rising inflation rate has certainly not escaped the attention of those on Parliament Hill, and the Conservative finance critic is a guy from the Ottawa area named Pierre Poilievre, and he had this to say about all of that not too long ago. Sheldon, let's roll that clip, please.
The Bank of Canada is not supposed to be involved in fiscal policy. Unfortunately, the Liberals have politicized the Bank of Canada to use it as a printing press to fund their inflationary spending at a great cost to Canadian consumers. The cause of inflation is large deficits. that are sending roughly $500 billion competing for scarce goods and driving up prices. The solution is to end the inflationary deficits. And then the Bank of Canada wouldn't be printing the money and driving up prices in the first place. Frankly, these deficits are leading to a higher inflation, and they risk leading to higher interest rates down the road. And that would be a disaster for our heavily indebted country.
Benjamin, how much of all of that do you sign on to as well?
Well, I think that clearly the injection of money into the system is clearly helping inflation. There is no question about it. But we have to remember that we went through a major pandemic, and it's not over yet. We had a shock to the system, and you had to do that. There was no choice. You can argue whether or not it was too much, too long, but we had to do it. And the only way to do it was to use the Bank of Canada. That was not using the Bank of Canada as the ATM of the government. It's really a misconception. It was basically quantitative easing that now is basically ending. So that was the right thing to do. And we knew that that can lead to inflation. Add to it the supply chain story and the fact that there is so much pent-up demand for services, and you have an inflation story. The only question is how long it will take. So I'm not buying all those arguments. It's not just fiscal. It's much more than that. We had a very, very major issue to deal with in the short term, and it's not over, as we all know. I think that another factor to consider is that the pricing power of companies is still there. That's going to your previous question about inflation and the willingness of people to pay. I think that when you look at the consumer, this consumer is still sitting on an elevated level of cash, about close to $91 billion of excess cash, and they are eager to spend that cash. And the pent-up demand is there, especially for services. And you're not going to bargain with the hairdresser if this haircut is going to cost you $5 or $10 more, because you have the money and you're eager to get the service. So the pricing power of services is actually back to what it was, because the price sensitivity of consumers is actually lower than it used to be. That's inflationary by definition. And that's something that will continue to be the case over the next 6 months. Another factor to consider.
Rebekah, let me ask you something else about what Mr. Poilievre just said, and that is that the Bank of Canada is supposed to be an independent organization that makes its decisions sort of absent from the political imperatives of the day. And he kind of suggested that the Bank of Canada has given up some of that independent authority and basically done what the government has demanded of it, namely print more money, fund stimulus spending to the tune of, I guess, a $350 billion deficit last year, which is, of course, the highest of all time. Has he got his finger on a potential problematic issue here?
I would agree with Benjamin, is that, if we look in hindsight, that, this type of spending was needed to avoid a far worse outcome. Had Canada not spent, the $350 billion deficit spending last year, we would be in a far worse situation now. And, hindsight is always 20/20. Could it have been done differently? Could it have been slightly smaller because of that overshoot? Well, we certainly hope that those analyses are done and that we learn going forward what are the best tools, ideally automatic, that have less, political discretion in how quickly they can be rolled out. I'm sure there are lots of lessons, but, in hindsight, we are in in arguably a better position in Canada than many other countries that didn't have that space to provide such big responses to the pandemic. So looking back, it is what it is. In economic terms, it's a sunk cost. It's more, where are things going? And I think for the most part, the Bank of Canada, we as economists look at market metrics. How are markets pricing in inflation risk? How are markets pricing in their expectations around the Bank of Canada movements? And markets would say they're fairly well anchored. So the credibility of the Bank of Canada is still, on very solid grounds in that regards. But I would say, if there's still any doubt, again, the Bank of Canada ending its purchase programs, was another sign of credibility that this wasn't going to go on forever and, continue to fund ongoing commitments. What we already see as well is that, federal government spending has been contracting fairly quickly, even on a quarter by quarter basis, faster than most of its peers. But that said, I still think another factor that we have to consider is that Canada is a very decentralized country in many terms, but including in fiscal terms. And so provinces, carry a good part of the spending in the country. And so when we look at what the federal government is doing and, the big money they've been spending, they've actually allowed provinces to come out of this with really pretty modest deficit spending at the end of the day, and spending that's, contracting fairly quickly, that we already have a couple provinces in surplus, and, and it should really help other provinces move in that direction faster. So I think, just to reinforce that, I don't think, there's any concern that the Bank of Canada's credibility and its inflation targeting regime is in question. And then the question then of how, what is the fiscal authority doing, or what is the finance department doing? There are quite a few considerations that, that we need to consider before we say that, that it's unanchored.
Well, let me ask whether or not, Benjamin, you think one of the things that ought to be under consideration now is a tried, tested, and true option when inflation gets out of control, and that is raising interest rates. Do you think that's advisable right now?
The short answer is absolutely yes. Interest rates are at 0.25. That's emergency rates, and we are not at the emergency situation now. So interest rates are extremely low, too low, leading to this very strong housing market, too strong, in my opinion. And therefore, clearly, there is a need to raise interest rates, and the market agrees with me. In fact, the market is now pricing in a situation in which the Bank of Canada will be raising interest rates 5 times or maybe 6 times in the course of 2022. Just a few months ago, people were talking about the first move only in 2023. Now we're talking about 5-6 moves in 2022. That's a very significant move. Now, I don't think that the Bank of Canada will move so quickly. I think that will be a mistake, because every economic recession was helped, if not caused, by a monetary policy error in which central banks raise interest rates way too quickly and basically kill the economy. You want to go baby steps, but you want to start early to reestablish or establish that credibility that you are fighting inflation. When you have inflation at 4.7% and interest rates are 25 basis points, you basically have to start raising interest rates, and they will start earlier than believed just recently, and that will be a good thing. This economy needs higher interest rates, but you need to go slowly. Don't, shock the system by raising interest rates 5-6 times during the course of 2022 and in the middle of a pandemic. That's more or less where we are.
Less than a couple of minutes to go here, Rebekah. Can I just get your understanding of Benjamin's advice there? Baby steps would mean what?
Well, we're right now, our forecast, which we are in the process of revising, we do see them moving middle of next year and fairly quickly. Our starting point is 100 basis points, but more on the side of sooner than later, and more than, that, and another 100 basis points in the year after. So, but I would say, just adding on to Benjamin's take, is that one thing we have that we haven't had in past cycles of raising rates is that now there's more of a risk on the side of, an overshoot of what we expect on inflation. So there's a risk that waiting too long could mean an even faster and more aggressive rate tightening cycle that would have to happen if inflation overshoots on the upside over that horizon. So that could have a potentially even higher disruptive impact if we let low interest rates run for that much longer, thinking it's out of a kind of a prudential or a precautionary basis, given that we have more of that risk that we might be wrong on where inflation is 18 months from now. So I think there's more of a two-sided balance of risk that they need to consider when they're thinking about that pace. And just the latest job numbers, job unemployment's back down to 6%, which is, some say that is, that's full employment. And so we are, at a point in time where I think it is, certainly warranted considering what, how early and at what pace should they start tightening rates, and do it gradually and allow yourself time to assess in between each rate hike, as opposed to being forced because of what is, could be considered, very high inflationary pressures that are not going away.
You two have been most helpful in helping us better understand the issue of inflation and what we're dealing with these days. A a rate of inflation that we haven't seen in almost 2 decades. Rebekah Young, Benjamin Tal, really good of both of you to join us on TVO tonight. Thanks so much.
Pleasure. Thank you.
Thank you.
The Agenda with Steve Paikin is made possible through generous philanthropic contributions from viewers like you. Thank you for supporting TVO's journalism.